Hello everyone. Today, we will look at some funds that have recently been onboarded onto our platform. There's a wide variety of funds covered today, including a US value-oriented fund, a set of funds launched by Capital Group, an actively managed fund that puts a twist on passive investing, as well as an ESG-compliant fund focusing on climate leaders. We also highlight our current recommended fund for China A shares and its newly launched CPF-OA eligible share class. First up, we look at the Neuberger Berman US Large Cap Value Fund, especially given our preference for value over growth stocks due to value's relative resilience amidst the current macro backdrop and the significant valuation discount it offers relative to growth. The Neuberger Berman US Large Cap Value Fund seeks to achieve long-term capital growth by investing in undervalued US large cap equities. Its benchmark is the Russell 1000 Value Index, though this benchmark is only used as the fund's investment universe and for performance comparison purposes. This fund is actively managed, and the managers do not intend to track its benchmark. Sectorally, this fund has large overweights in healthcare at plus 7%, as well as consumer staples and utilities at plus 6% each. This fund is well positioned in defensive value stocks, given their expectations of heightened market volatility in this time period. In contrast, they have similarly large underweights in consumer discretionary, IT, and real estate, holding a 0% allocation into each of these sectors. This fund's willingness to take significant off-benchmark positions can be seen not only from its large overweights and underweights seen in the previous slide, but also through its relatively high active share, where 68% of the portfolio allocation is different from its benchmark. In addition, this fund has a lower average forward PE of 12.5 times compared to its benchmark's 13.8 times, which is likely a natural result of its value-driven approach. In terms of performance, this fund has not been spared from the broader sell-off observed in US equities, and has performed similarly to its benchmark since inception. It has an expense ratio of 1.55% and is available in one share class, Class A Accumulation USD. Next up, we look at three new funds launched by Capital Group. Capital Group was founded in 1931 and is one of the world's oldest and largest investment managers with an AUM of about 2.2 trillion US dollars. It has adopted a unique multi-manager structure across Capital Group funds, unlike many other funds which have one or two star managers instead. In Capital Group, each portfolio is divided into separate segments, where each portfolio manager, averaging 27 years of experience, is responsible for their own portfolio segment. This structure has several benefits. For instance, fund managers may have their own specific areas of expertise, and they may do better in growth versus value or vice versa. And this allows for consistent performances throughout different market conditions. In addition, portfolio performance through this system is an amalgamation of many portfolio managers' investments and is therefore less vulnerable to risks associated with isolated decision-making. Finally, the retirement of a single portfolio manager out of many will have a lesser impact on the overall portfolio, allowing for a smoother transition. With a better understanding of Capital Group, we now take a quick look at three Capital Group funds that have recently been onboarded onto our platform. The first Capital Group fund today is its New Perspective Fund. New Perspective is one of Capital Group's flagship equity strategies. It is an all-weather strategy which aims to generate positive excess returns across different market environments and cycles through investing in global equities. This strategy was launched in 1973 for US investors, though this particular fund itself was launched only in 2015. This fund has a relatively diversified exposure covering many sectors, though it is tilted towards IT at 20%, consumer discretionary at 17%, and healthcare at 15%. This is likely a reflection of the fund's long-term belief that the 2020s will be a decade of accelerating digital adoption and healthcare innovation. This strategy has underperformed the MSCI ACWI index over the past year, but it has also demonstrated robust performance over longer-term horizons. If we look at rolling returns over a 3, 5, or 10-year horizon, this new perspective strategy has generally outpaced the index over 80% of the time, highlighting its track record for long-term performance. This fund has an expense ratio of 1.59% and is available in 4 share classes. 3 accumulation share classes for Sing Dollar, US Dollar, and Sing Dollar hedged, as well as an income class for US dollars. The second Capital Group fund today is its New Economy Fund. Capital Group's New Economy strategy focuses on innovation and invests primarily in companies that can benefit from said innovation, exploit new tech, or provide products and services that meet the demands of an evolving global economy. The strategy was launched in 1983, though the fund itself was incepted in 2019. Today, the fund sees several innovation trends, including the pervasiveness of technologies across all industries and the rapid transformation of healthcare. As such, it is unsurprising that their largest overweights are in IT and healthcare. Investors should also note that the fund currently has a large cash position of 11%. This fund invests across the market capitalization range, with more than half of its 226 holdings having a market cap below $50 billion. This is because it believes many innovation trends are better represented outside of the megacaps, which have consequently contributed significantly to excess returns over the past 10 years. This fund has underperformed the MSCI ACWI index over the past 5 years, but has slightly outperformed its reference indices over a longer time period. This fund has an expense ratio of 1.65% and is available in 3 accumulation share classes in Sing Dollars, US Dollars, and Sing Dollar hedged. The third Capital Group fund today is its New World Fund. Capital Group's New World strategy targets companies with a significant exposure to emerging markets or EMs. This strategy was launched in 1999, though the fund itself was incepted in 2016. In contrast to many other EM funds, this fund is actually permitted to invest in developed markets or DMs as well, as long as they have an EM revenue exposure of at least 20%, as you can see from the table on the left. Within the entire portfolio, it has a 39% allocation to EM domiciled equities, much lower than the MSCI EM index's 100%. The fund managers believe that this domicile-agnostic approach allows them to invest in global industry leaders, who can also benefit greatly from rising prosperity in EMs. While this fund has underperformed the MSCI ACWI index in the past year, it has managed to generate some excess alpha over longer time horizons. This fund has an expense ratio of 1.9% and is available in 2 accumulation share classes, Sing Dollars and US Dollars. Next up, we look at the JP Morgan Fund's Global Research Enhanced Index Equity Fund. This fund uses an enhanced index strategy where it is actively managed in reference to its benchmark MSCI World Index. It does expect its performance and risk characteristics to closely resemble its benchmark, though it also aims to achieve an excess return over its benchmark in the long term by optimizing the stock ideas of its 80-strong research team, as shown by the chart on the right, which shows the historical performance of the underlying Research Enhanced Index. This fund has a similar sectoral allocation as its benchmark. Its largest off-benchmark position is in industrial cyclicals, with just a 0.8% deviation from its benchmark. We see a similar trend in terms of geographical allocation and top 10 holdings, which are both very similar to that of the MSCI World Index. This represents an interesting approach to active investing, where investors can achieve returns likely similar to the benchmark, while also leveraging on the ideas of JP Morgan's research team. In fact, it also has a similar product listed as an ETF, which is the JP Morgan International Research Enhanced Equity ETF, which adopts a similar methodology but for developed markets excluding the US. This fund's return has marginally lagged its benchmark since its inception about 2 months ago, with negative absolute returns due to the global equity sell-off. While no expense ratio has been provided for this fund due to its recent inception, investors should expect a management fee of 0.38%, as well as operating and admin expenses of 0.15%. This fund is available in one share class, Class A accumulation Sing Dollars. We now move on to a new ESG-friendly fund by Manulife. With the trend towards carbon neutrality continuing to pick up steam across the globe, the Manulife Global Fund, Global Climate Action, aims to achieve long-term capital growth by investing in global equities, into companies it deems to be climate leaders, which are aligned with the principles of the Paris Agreement. Its benchmark is the MSCI World Index. Its sectoral allocation is similar to its benchmark, with a large 70% allocation into US equities. What is more interesting is that on a sectoral level, it has a large overweight in industrials, funded by underweights in sectors like energy and materials, which traditionally contain more carbon-intensive companies. The fund's top 10 holdings comprise a mixture of established names like Microsoft and smaller caps like McKesson Corporation. Interestingly, these top 10 holdings do not include big tech companies like Google and Apple, which commonly appear amongst the top holdings of other global ESG-aligned funds due to their relatively lower carbon footprint. In terms of performance, this fund has performed similarly to its benchmark since inception. While no expense ratio has been provided for this fund due to its recent inception, investors should note that there is a management fee of 1.5% amongst other fees. This fund is available in 3 accumulation share classes, in Sing Dollars, US Dollars, and Sing Dollar Hedged. Finally, we look at a familiar fund which has recently onboarded 2 new share classes. The Allianz China A-Shares Fund seeks to achieve capital appreciation and above-average participation in price changes through investing primarily in China A-Shares. It has been a recommended fund for China A-Shares since 2020 due to its strong outperformance over benchmark since inception. This fund pursues an all-cap strategy, keeping its sector allocation similar to its benchmark MSCI China A Onshore Index, with a maximum deviation of 5%. However, it is comfortable to take off-benchmark stock positions within each sector, and its top 10 holdings differ slightly from its benchmark, for instance with the inclusion of smaller companies like Enjoy Foods Group. We have recently onboarded 2 new share classes, ET Accumulation SGD and ET Accumulation SGD Hedged, both of which are available for subscription using CPF-OA funds. As such, investors who wish to gain exposure to China A-Shares should consider this Allianz fund, either in its original AT share class, which is unavailable for CPF-OA, or its newer ET share classes, which are available for CPF-OA. With that, I've come to the end of today's video. Thank you for watching, and see you soon.